Hey, this is Hutch with bankingtruths.com, and today we're going to explore whether whole life's fees, the hit to liquidity, the commissions, whether or not it's worth it when using whole life as your own bank for IBC, or the infinite banking concept. Now, before we look at specific examples, I want to compare it to something that's very hot, very sexy right now, real estate investing. So most of my clients that come through are either already investing in real estate or they want to invest in real estate. And yet with real estate, they know they're going to be behind for the first few years. They're going to have to pay a realtor commission. They're going to have to pay loan origination. They're going to have to pay for improvements like paint, flooring, curtains. Yet they don't mind being upside down on that investment for the first few years because they know they're going to get three long-term benefits. They're going to get some long-term appreciation. They're going to get some steady cash flow over the years, and they're going to get some unique tax benefits. And the same is true with whole life. In fact, it's actually guaranteed in the contract. Okay, so let's go ahead and put some numbers to this. So with the example below, you can see that the first couple years are the worst years. That's always the case with whole life, meaning you put money in premiums, not all of it is showing up in cash value. So the question is, did you just get scammed? Did that money go down a black hole? Or are you going to get something for your money? And haters of whole life will say, well, maybe you get something, but it's expensive. Yet the last time I checked, my most successful clients, they're never buying the cheapest cars. They're never buying the cheapest houses. They're never buying the cheapest phones. And the people I do know that do that are not necessarily the people I want to be emulating financially to take advice from. So let's go ahead and see what you get for that money, and you can decide whether or not that's expensive. So let's talk about that first benefit of real estate, the long-term reliable appreciation. Now, it's not guaranteed to happen, but other than a few hiccups in history, real estate has steadily appreciated. However, my most successful real estate investors never get to truly enjoy that appreciation. It's really left behind for heirs. What they are concerned about is that steady cash flow, which we're going to talk about with whole life in a second. But going back to the guaranteed appreciation of whole life, a lot of people don't know this, but with any whole life policy, the cash value has to equal the death benefit by age 121. Now, I realize most of you won't make it to age 21. I'm pretty sure I won't. But what that means is your cash value is on this guaranteed channel, this guaranteed track to equal the death benefit, and it appreciates the majority of it by life expectancy. However, wherever you fall on that curve, there's still some amount of death benefit over and above the cash value that your heirs get, just like with the real estate investors, over and above the cash value that you get to use and enjoy along the way. So I realize that most of you wouldn't prepay up front for a death benefit that your heirs are going to get in the future. But what I want you to see is the money's not going down a black hole. This is the first benefit you get of three, that when you pay those premiums into whole life and some of it doesn't show up, the insurance company is actually putting money in their vault earmarked for your family. And depending on when you die, if you die very early, you get a lot of death benefit. And the longer you go, you have most of that equity available to you in cash value, but there's still something, some amount that your family gets. So is this worth it? Well, you can see you actually get a pretty decent rate of return if we measure it. Again, I realize you wouldn't just do this in a vacuum, but this dovetails into the other benefits that you get, such as unique tax benefits. All right, so let's unpack benefit number two, the unique tax advantage of using life insurance as your own bank versus keeping it in traditional banks, even the highest yielding savings accounts. The problem with these are that even though right now you're earning a nice rate of interest, maybe something in the 5% range, Uncle Sam wants somewhere between 1/4 to 1/2 of that, depending on how much money you make and what state you live in. But not so with life insurance, because it provides a social good in the way of a death benefit for grieving widows, orphans, even failing businesses with key man policies. The government incentivizes people to put money in life insurance policies that don't go away. And that's why you get your cash value growth tax sheltered while you're alive. And as long as you leave that little bit of death benefit over and above your cash value, even if you used and enjoyed all the cash value while you're alive, none of it will be taxed. As soon as that death benefit is delivered, all of it is tax-free. And that's a massive tax advantage. In fact, if we look at our same example, you paid these early premiums, the money didn't show up in cash value, but you avoided this much in tax by your life expectancy, in this case, age 85. A lot of people would actually do that. If I said, hey, look, you can prepay this amount for all future tax and avoid this much taxes on your savings, most of you would probably say yes. But the bank doesn't offer something like this, yet life insurance policies do. So on to benefit number 3, steady cash flow. People love this about real estate, but aren't exactly sure how it translates to whole life insurance. So we already talked about how the cash value has to equal the death benefit on a guaranteed basis, but you may have heard of whole life dividends. We actually have an article about that, and that only happens when you buy whole life from a mutual company. We also have an article about that too. So when you buy a whole life policy from one of these mutual companies, you actually become part owner in this company. And these companies have a history, 150 years, 160 years, 170 years of paying dividends every year to their policyholders. Even though they don't have to, they have done it. In fact, a couple of them even boast that they paid dividends throughout the Civil War, which is crazy to think how many people were dying and all the economic uncertainty. And yet these are the most solvent and financially stable companies in America. In fact, long before there was FDIC, mutual companies are the ones that bailed out the biggest banks. And a big part of the reason why banks keep getting in trouble, just like they did a couple of years ago, is they're taking $1 of deposit from you and they're loaning that out 5, 10, 20 times on the dollar. Meanwhile, life insurance companies have much stricter reserve requirements because they are providing for widows and orphans. And so they have to keep $1 and a nickel to $1 and a dime for every long-term liability they have, mainly death benefits. And so it's a much more stable business model, which again, you are part owner of and get to reap those benefits. And because your yield isn't just coming from prevailing rates, it's also coming from one of the oldest and most conservative business models that exists in America, you actually get steadier long-term yields over time. If we overlap prevailing rates with dividend rates here, you can see that there are periods of spikiness, including now where rates invert. We're in an inverted yield curve, but it's like a sugar high. They don't last long. And it's interesting because people feel very complacent because of the rates we're getting now in high yield savings accounts, like they've been around forever. But meanwhile, if you would have been in whole life for the last decade, you'd be much better off, even if you're a little bit behind right now, not to mention the tax advantages, which really makes it feel like you're ahead anyway. And in fact, my video, bankingtruths.com/savings, it actually compares a whole life policy from 1980, not even optimally designed for banking with term riders and such. It's just an old stock 10 pay versus the high yield savings rates at that time, which started at in the double digits, like 16%. You could see whole life was behind for the first few years. But again, with the tax advantages, it didn't necessarily feel like that. But over the next few decades, they were way ahead. So the time to think about starting one of these policies isn't when rates uninvert. It's now. It's sow the seeds now, because with any whole life policy, your benefits, your cash flow, your dividends, your appreciation gets better and better the more you put in. It's just basic compounding. And that brings up another very unique benefit of using whole life for infinite banking. And that's the ability to keep your money compounding even while using it for other things. And we do this via borrowing against your cash value. So rather than be on the saving, spending cycle where you have a bunch of single use assets and you save and then consume and lose all the compounding from that, by deploying the same cash flows into a whole life policy designed for infinite banking and simply borrowing against your cash value that's guaranteed to grow no matter what, when you pay down the loans, just as if you were going to refill a savings account that you emptied, you actually end up in a higher place in line than any savings account, and it just blows it away. By the way, we also can do this with a combination of assets, and I've recently put out a very extensive webinar called 4D banking, or four-dimensional banking, that talks about different dimensions, different asset classes, and different dimensions that we're looking for within each asset class to produce optimal results in terms of growth and borrowing options, not to mention tax benefits. So definitely check that out. I hope you enjoyed this take on whole life's early fees, and hope you realize that it's not just going down a black hole. You're not getting scammed. You actually get some benefits for your money. And if you want to see if the cost is worth the benefit, I strongly suggest you book a slot on our calendar and we can custom model these policies, whether it's on you, on a family member, to see what the actual cost benefit is. And then that way you can be more informed to make a good decision to see if building your own bank with life insurance makes sense for you for real estate investing, retirement, or whatever you're going to use it for. Hope this helps. We'll talk to you soon.